Hi everyone, I hope this video finds you well given the uncertain times we're all experiencing. In this video I'm going to talk about the 5 reasons why you should not buy a house right now unless unemployment rate figures for the month of April were recently released and it currently sits at 13%. I want to show you this chart. This chart goes back to 2005, and the reason why I did that, I wanted to show you the trend. So you can see it goes up, it goes down, and then you can just see the magnitude of the situation we're currently in at the far right. So the second chart here, it's the same one, it's just zoomed in a little bit so you can see more clearly the magnitude of the insane increase that we've just experienced. So the question is, how many of those currently unemployed will get hired back? New habits and consumer behavior. So during this time of isolation and quarantine, it's dramatically changed how we all live. I remember reading The One Thing. It's a book by Gary Keller. It's a great book, by the way. If you're looking for something to read, highly suggest it. But in the book, Gary talks about habit forming and the role of discipline and achievement. I'm not so sure the extent of research involved with the whole 66 days to form a habit thing, but it's interesting to think that given the time we've been in isolation and quarantine, whether we know it or not, we've all formed new habits, and I just wonder what that is going to mean for some of those industries I just mentioned. So this is a scary time for Canadians. Many of us are over-leveraged with debt to the point that missing even one paycheck could significantly impact one's ability to pay our bills and service our debts. I found this study, it's done by Ipsos. I'm not sure if I'm pronouncing that right or not, but as you can see from the title, it says nearly half of Canadians, 48%, are $200 or less away from financial insolvency. So that's a pretty bold claim. I'm not sure, with regard to the study. If you want to know, you can check it out, but let's just even say that's 30%. That's still a staggering figure to the severity of how over-leveraged Canadians are. So right now the Bank of Canada interest rates are already low at 0.25%. The next reduction would be 0. I'm not even sure if that's been done before. But that brings the question, what can the Bank of Canada do to stimulate the economy? Interest rates are already low. I want you to look at this chart. So this is the debt service ratios for households in Canada. It doesn't seem too crazy. There's 2 categories of debt: mortgage debt and non-mortgage debt. HELOCs, home equity lines of credit, are considered non-mortgage debt, but they're still borrowed and leveraged against our real estate. But I've heard, and I have nothing really to back this up, but I've heard that the HELOCs can account for 30% of the non-mortgage debt. So when you're looking at this chart and seeing the mortgage debt borrowed against our house, and then 30% of the non-mortgage debt borrowed against our homes, you can see the debt burden that we have on our homes is at historic high levels. I found this chart and was able to compare the debt levels experienced in the US in the financial crisis of 2008 to that of Canada. So if you look back in 2008, you can see the peak USA was at 18.3%, where currently in Canada we're at nearly 24%. For those that don't know, the debt service ratio is the percentage of our income that we must use to pay and service our monthly debt. So when you put that into perspective of 24%, that's nearly a quarter of our incomes are going just to keep us afloat, just to service the debt payments. So for those that know me, I don't like to be pessimistic. For the most part, I'm a positive person. But part of me wants to see a market adjustment because the cost of home ownership is just getting out of control. I want you to look at this chart. So this is the Consumer Price Index. You can find this chart on Stats Canada website. If you're into this kind of thing, highly suggest it. It's an interactive chart. It's really neat. You can pick whatever you want. So what I did is I picked the cost of home ownership index versus the cost of renting index, and then also included the blue line, which is the index for all items. So you can see from a historical perspective, they've remained close for many years. The last time the cost of home ownership spiked, we saw a market correction with real estate prices and the economy which brought things back in line, and that was in the early 90s. But as you can see where we're at now, that's a pretty wide spread between the two. This is another chart that I made, and this shows the percentage difference between those two index values, so cost of home ownership and the cost of renting. So the red line that you see is 0, meaning that both home ownership and renting are the same cost. When the yellow line is above the red line, home ownership is more expensive. And when the yellow line is below the red line, renting is more expensive than owning. So that hasn't happened many times, as you can see, but it did back in the 70s. But if you fast forward to right now, this is the widest spread that at least I can see according to the data that I have that goes back 42 years. But it's nearly 20% more expensive to own than rent. As a real estate investor, I'm constantly analyzing properties, trying to see if I can get them to cash flow. So I can tell you if you're purchasing an investment property using conventional investment strategies, wherein you put 20% down, amortize the mortgage for 25 years, it's incredibly difficult to get that property to even break even. In most cases, you're in a negative cash flow position. So it just makes me wonder, how are investors doing it that have purchased properties up until this point? They've either put down 30 to 40% equity or a down payment to try and get that property to break even or maybe generate some positive cash flow. They've maybe extended the amortization to 30 years to try and bring that mortgage payment down. Or maybe some of them are just running in a negative cash flow position. They're running the property in a deficit. And I can see maybe the math that they're maybe doing, that market appreciation has been so dramatically high that it kind of covers the costs of those monthly losses they're experiencing. It's kind of different math, but I can kind of see it, but it still doesn't work for me. But it just makes me wonder, is there another market segment that could be impacted from this? So real estate prices, in the simplest form, are generated from supply and demand. When I got into real estate in 2013 as a professional, since then, up until this time, it's been predominantly dominated as a seller's market, meaning the supply of homes is low compared to the number of buyers. Interest rates have been low, access to money and credit is cheap and readily available, and people are spending money. And real estate prices have been appreciating at very high levels, to the point that the government had to step in 2017 with a policy change. And since that policy change, it has cooled the market to some extent and created more of a balance. Up until late 2019 and early 2020, before COVID-19, the supply of homes started to decrease, which in turn resulted in increased selling prices. So our selling prices were coming up. Then COVID-19 came. So this chart here shows the monthly supply of homes listed on the MLS going back to 2008. The higher the line, the more supply in the market. The lower the line, the lower the supply. This next chart shows the median price trend going back to 2008. It's kind of like a reflection of the monthly supply chart. So let me show you what I mean by reflection. So on this chart, take note of 2017. So the green line, which is the supply of homes, is way down, historically down, just so low. But in contrast, the blue line, the sales prices, has dramatically increased. And that's the effect of supply and demand. So with such uncertainty surrounding people's employment, and employment is what produces the income that we need for spending and servicing our debts, assuming that the government can't keep filling in the holes and paying everyone's income for the next year or so, I think we're going to find situations where people are forced and they have to sell. We're not going to see this for another 6 to 8 months, in my opinion, just due to the fact that courts have been closed and there's probably a significant backload in that system. And with the power of sale process, it can kind of get drawn out. Plus, many have deferred mortgage payments. So it's going to be interesting to see. We're not going to see that immediately, but like I said, within a 6 to 8, 9 kind of months, I think that's when we'll start to see some of those situations come. And in saying that, I'm confident that within the next 5 to 9 months, we're going to start to see increasing supply. which, as we have learned, in most cases results in a decreased selling prices. So if you're looking to buy with a long-term perspective, you've got nothing to worry about. So prices may decrease in the short term, the next 1 to 3 years, but long-term, prices will be back to where we are now and beyond. It's a natural progression that's happened over time. Take a look at this chart. This is a chart that I put together. It's amazing how long it took to do this. I did this a few years ago, but you can see from 1960 the amount of times prices have gone down, and it's surprisingly not that many times. But when they do go down, it always rebounds. So sometimes it can take longer, but prices always seem to find their way back and then exceed where we currently are. It's a natural progression, as I already mentioned. Unless you're looking with a long-term perspective. So if you're going to live in the house for years and years, you find a good deal, which deals have been popping up, so keep your eye on the market. But with that being said, who cares when you buy? So long as you can service your payments, go for it. Seize the opportunity, and when it comes time to sell many years down the road, this little blip, it simply will not matter. If you're looking to buy a house in the short term, you should be very careful, such as looking for a house to flip. Just be very careful. It's still possible, but be careful. If you're buying and selling in the same period of time, again, it does not matter. So if you're going to sell in May and buy in June, it doesn't matter. It's all relative. Regardless if you bought or if you didn't buy, whichever home you're in, if the market increases or decreases, you're going to experience it on that property. So if you're in that situation, again, it doesn't matter. If you're thinking of selling in the short term, it might be wise to consider selling sooner than later. I welcome questions and constructive dialogue. Drop me a comment or contact me. You can get me at my website, JeffGilbert.ca. And if you'd like a copy of my price forecast, just reach out. I did this model in Excel. It's kind of neat. So if you're looking for deals and you could kind of relate that to where potentially the market can go, it could be of help. I think it's pretty neat. And if you'd like a copy of it, just reach out and I'll send it your way. So again, thanks for watching, and we'll see you on the next video.